Hey, hey,
World Wide Web,
that's right.
YouTube, TikTok, Instagram.
Anywhere, anywhere you're watching this from the World Wide Web. My name is David Dowd, and this is
My name is Bathsheba Payoute. I'm a loan officer with Groves Capital. I am licensed in Florida, but we also have license in Texas and other places as well.
my name is David Dowd. I have my own business called David James Investments, and my brokerage is Equity Smart Home Loans. We have over 150 different banks that we can do loans through. And today we are continuing our journey through the Fannie Mae guidelines. We're going into subpart B2 eligibility, and then more specifically, Chapter B2-1 mortgage eligibility. And we'll be covering a few sections here, primarily section B2-1.1, occupancy types, and section B2-1.2, which is LTV, CLPT, and HCLTV, and subordinate financing. Before we get started, always make sure to check the guidelines before using anything that we talk about in this video today as the actual guidelines, because they are changing all the time. Okay,
Yes,
very important. Anything that we say, always check with your lender. Always check with
yes,
your customer about these options we talk about, because we're human. So
right.
there's always a possibility for human error. And of course, we apologize in advance, but we will try our best to keep this as accurate as possible, but just some cautionary tales ahead of time. With that in mind, Bathsheba, what did you think about the occupancy types?
Okay, occupancy type was very interesting, especially the principal resident properties. So that's basically saying who is when you get a home and you become that home becomes your homestead. So they want to know who is the one that's on the going to be on the title, who is going to be who's going to be the guarantor to make sure that you are actually living in that home. You're not just renting that home out. So they had different borrower types. The first one they had was multiple borrowers, which says only one borrower must occupy and take title to that property. So you may have different people that signed up, like you, your spouse, your friend, or business person. So at least one person has to be living in that home that's in that borrower's list. Then they have the military service members, which was very interesting as well, because, sometimes militaries are active duty. So they talked about how that they understand that you may not be there all the time, and you may have someone else be there to be considered a non-occupant in the home too. That
Mhm.
if you're going to Alaska, or if you're in Florida and then had to go active duty to another country like Japan, then you just have to show proof of that to show why you're not going to be there, and who is going to be there in your stay if they're not on the IOU, which is the note, promissory note that you're going to pay back, or in the title. And the
Yeah.
last part is the parent or legal guardian wanted to provide housing for a handicapped or a disabled child. So if the child is unable to work or does not have sufficient income to qualify for a mortgage on their own, the parent or the legal guardian is considered the owner occupant.
Oh, that's the owner, but they don't live there. But because of
Right.
this exception to,
Because of
they normally would not be okay with that, because it's supposed to be primary unless it's identified, right, as a
right.
secondary or investment property. But in this case, they're okay with it because there's that direct connection, and vice versa, right? Because that goes further down to say that the parents can do the same thing for the children. And so
Exactly. It
that's
even
pretty
talks
nice.
about the child wanting to provide housing, but the parent is unable to work. But the
Right.
child has sufficient income and he wants to continue paying the mortgage, or he wants to own the house, then he can qualify on their own, and the child will be considered the owner occupied. And they may not live there, the parents will live there, but they're still considered it.
The principal residence, it still falls under that category. And then with the military, them not being there, right? But
Right.
because they're serving our country, right? So
Right.
therefore, that's cool too. They're not gonna give you a hard time about that. You just got to prove it, like you said. You got to prove
Yeah.
that. Now, Fannie Mae purchases or securitizes mortgages secured by properties that are principal residence, second homes, or investment properties. So right off the get go, in this particular section, it talks about like what is it that Fannie Mae is looking for in a loan, and
Mm-hmm.
how is that relevant to occupancy? And so those are the only three that it's cool with: primary residence, second homes, and investment properties. Right past the part of children and parents being able to support each other in the way we talked about, and not actually having to live there, which is crazy cool.
Right.
Then it starts diving into second home properties. What were your thoughts on second home properties?
Clients want to say, this is my second home, but sometimes I rent it when I'm not there. Oh, renting is a trigger word. When you
Mm,
say that you're renting, it starts to become an investment property. Investment properties are different than primary homes and secondary homes. Investment properties typically have a higher interest rate. They typically require more down payment. These are the key words as lenders that we have to investigate to make sure that we're giving you the proper loan for your type. So the
mhm.
criteria for a secondary home is that you have to use that home for some portion of the year. So a lot of people that are blessed, they're able to have their standard home and then they have a summer home. Snowbirds, basically, they live in New York or Wisconsin or somewhere really cold. So in the summertime, springtime, they're there. And then when it gets too chilly, they come to Texas or Florida, where it's or Puerto Rico, and they have their home there and they spend the other half of the time there. And then they also look, when you're looking for secondary home, is the location. How close is it to your primary home? If it is it right down the street, well, why are you getting two homes right down the street? That could be another trigger to saying, well, maybe this is more of an investment. So it has to be restricted to a one-unit dwelling too. Your secondary home can't be a duplex because they know that second unit will be used as a rental. So then it eliminates it from being a secondary. Now it's considered an investment. The borrower must have exclusive control over the property. You have to own the property. And the most important thing must not be a rental property or a timeshare arrangement.
One of the things I think is most interesting when it comes to identifying a property as a second home or an investment and why they care so much, right? You ever thought
Yes,
like, why do they care so much? Like, who
right,
cares what I'm doing? I'm gonna get the property. You're gonna get the
right,
loan. Everyone's
right,
gonna make some money. Who cares, right?
right.
Well, the reason why it matters is because when it comes to the lenders, they're only caring about risk. Okay.
Mhm.
So we'll get into this later with the whole lien positions, but basically, the further it is from your primary residence in terms of the loan that you're getting, so for a secondary home or investment, right? The less likely you're going to pay that when hard times come.
Mhm.
That's the way they look at the risk, right?
Great
So
topic.
if you go for an investment property, of course, like you were saying, Bathsheba, they're going to charge you a higher interest rate. They're going to charge you more. They're going to be more. They're going to scrutinize that file a lot more because it
Right.
is likely that that will have the highest probability of foreclosure
Yes.
over a primary residence. That's why they're a lot more lax and a lot more lenient with primary residence. So I thought that was really, you start to see that here. This is a
Yes.
little bit, just a little bit. You see that because it's like, oh, it has to be this and it has to be that. And oh my God, it
Right.
has to be this. And it's like, why is there so many requirements? Whereas the primary home, it's just like, done. Hey, your mom, your dad, they can own it and you can live in it and vice versa. They're very lax about it because, hey, it's a primary residence. But secondary homes, mm-mm. And defining a secondary home can be a little challenging also because there's a fine line between secondary home and investment property, right?
Yes.
They're properties you're not going to live in all the time. But the difference between the investment and the secondary is going to be that you have to be in that secondary home at some point in the year for some
Right.
period. Like that's one of the things. I'm probably getting a little ahead of myself here, but just for the sake of clarification, because I'm sure people are wondering that right now. What's the difference? But it's like investment, you don't have to live there at all. So therein, that's the reason it's the three main things. That's one of the things I gathered from this that I wish they would have talked about earlier in the guidelines. So I feel like that would
Right.
give us a little bit more clarity about like why do you care so much? The other things it has here cannot be subject to any agreements that give management firm control over the occupancy of the property. Again, that's investment property land where a
Mhm.
management company is
Right.
running the show on your
Right.
behalf. So that's why that's there. And then it must be underwritten in DU or desktop underwriter and receive an approved slash eligible recommendation. So basically, if our system doesn't say it's cool, it's not cool.
Right.
They have that much faith in their system, which, hey, you know what? Each
Yes.
their own. It then talks about LLPA, and it talks about that a few times,
Yes,
which
it
is the
does.
loan, was it the loan level price adjustment matrix? Ooh, like
Yes.
like Keanu Reeves or what, matrix. What is that?
Yes.
Like a
Oh,
price
that
index.
is a way for the federal loan companies to adjust the cost of a mortgage to offset the risk. In
Okay.
general, the idea is to make riskier loans more expensive without affecting the price of a safer loan. So that's why they have their metric system to see where it's located, the price, like, is it a secondary first home investment? And from there, they'll make those type of loans more expensive, where the first time home buyer, they'll tend to be more, you have a good, decent credit score, more relaxed on it. So they put it in there for verifying the risk for each loan.
It keeps coming back to that risk idea that we are talking about a
Yes,
second ago, right? Like, how risky is it for us to give you money for
right.
that home? Because at the end of the day, it is a business, right?
Yes,
And even Fannie Mae, as kind of a hybrid that it is when it comes to government entity and a business, is a business, right? Some
right,
portion of it is a business. Right now, I think it's conservatorship because of 2008. Either way, at the end of the day, they're trying to make money.
right,
And they have to balance the risk of, if we give this money to these individuals, are we going to get a return on investment or an ROI, right? Well, what's the likelihood? How are we going to determine that likelihood? It's like, I can see the future. No, you can't. No, you can't. So,
right.
and the same goes with like insurance, future
Yes,
topic, but that's the way the insurance companies are also thinking about taking on members, taking on policies, taking on properties even to cover under insurance. And so, risk, very important to understand. That is what dictates these guidelines we're reading, and also the likelihood of success of getting that loan, getting that financing. How risky do you look as a profile of all these conditions to the lender? Well, in the last episode, weren't we talking about how Fannie Mae is technically like more of the secondary market? So why do
yes.
they care so much, right? Like,
Because they replenish, if I may, they replenish back the loan. So when we send it over and it's approved, they it has to be at least, I believe, 2 years without being foreclosed. If it
mm,
gets foreclosed, they investigate to make sure we did everything we're supposed to do. If they find out we didn't do what we're supposed to do, the broker has to buy back that loan. It is their responsibility.
but here's the other thing, as far as like, why does Fannie Mae care so much about these things when they would probably be after the fact? Because they're
Right,
the secondary market. They're not the primary market.
right,
Primary market is all the lenders, right? And the banks. Well, the thing is, Fannie Mae and Freddie Mac are what I like to call the cookie cutters. They
mm,
like everything to be the same or within
yes,
this same realm of circumstances.
hmm,
So that includes risk, of course.
right,
What determines the size of that cookie cutter? It's the risk, right? And the return. So that's why lenders know ahead of time, like, I'm going to be selling this loan to Fannie Mae and Freddie Mac. It's conventional, right?
right,
That's where it's going to go. So because I know in the future that's going to happen, I have to make sure that the circumstances are ideal for that cookie cutter scenario that they want.
right.
And
As
that's
much as
why
we
they
can.
care. Yeah.
Hmm.
That's essentially why they
Very
care. So we're,
interesting.
we're just we're just skipping ahead, and that's what the lender, because the lender at the end of the day, that's how they're going to get their money back, to
Right,
be able to give more money to more people to get more homes. All this money is exchanging hands and money is being created, and it's crazy. And yes, it is. But at the end of the day, what is the mission, right? It's to help people get homes,
right,
right? So all of this leads to that. And instead of having to wait 10, 20 years to build up a down payment, you can get there sooner with some of these loan products. Future session there too, but just something to keep in mind as to like, why are they so strict? Why is there so many rules and so on? The next one is defining occupancy for a group home. What'd you have on that one?
eligibility and pricing for group homes will be the same as currently providing under the terms and conditions established for a principal residency or a second home or an investment property. So I thought that was very good too. Like if you wanted to do a group home to help people in need, it'll be considered as one of the three. It needs to be reasonable too, because we're out here. It is a business, but we're out here helping people. It's not a hotel. We're
Mhm.
helping people that are in need. So I'm glad that they don't consider it too much as an investment property. So,
Right.
so if those
No.
who want to change lives and do group homes, and you're like, oh, how would I start a group home for kids or for seniors or for people that just got out of prison? Well, you can get Fannie Mae to help you with that.
And good on you, because that
Yes,
takes a special kind of person, right? To
yes,
open up your home and be okay, like angels on earth, right?
yes,
Something
yes,
like that.
I agree.
I admire
Yes.
that. So that's actually the end of the first section that we've covered.
Mhm.
Lots of possibilities, right? I think that's the beautiful part. Like as we start learning more about the guidelines, more about what can be, we then find out that someone who maybe thought they couldn't get a home can actually get a home. Okay, so the next one
Absolutely.
here, section B2-1.2, and this is going to be for LTV, which is loan to value, CLTV, which is combined loan to value, and then HCLTV, which is home equity combined loan to value. I know they should have put an E in there, but I didn't make the rules.
Right.
And then, of course, and subordinate financing.
Oh, I learned a lot because I've always had a like I couldn't really grasp that loan to value, calculating the loan to value ratio. So a loan to value is basically a financial term that we use by lenders to express a ratio of a loan to value of an asset purchase. So it is a number lenders use to determine how much risk, going back to the risk again, David,
Oh,
they
yeah.
are taking on securing the loan. The higher the loan to value to be, the riskier because of the potential loss will be greater. So consequently, lenders often mitigate or reduce their risk by charging a higher interest rate on the mortgage loan. That goes back to your down payment. What is a loan to value ratio? It is the amount you owe on the loan versus the appraisal or sale price, whichever one is less.
Let's dive into loan to
Yeah.
value really quick and
Mhm.
get a better grasp of what this concept is and why it matters, right? Because you're
Yes,
thinking loan to value, what do I care? Like
right,
just the loan, that's all I should care about, right? And then
right.
later, after I pay off the loan, then the value, right? It's like,
Mhm.
well, because it's such a long time that you're going to be financing this home, anywhere
Right.
from 10 to 30 years in most
Mhm.
cases, we have these concepts that help to not only mitigate risk, but they also tell the buyer, the borrower, how much equity is built up in the home at a certain point in time through the amortization of that loan. So, put that in layman's terms, the loan to
Yes,
value is going to be here's the loan you have after your down payment. So, that, remember, it's after
right.
your down payment. So, all
After
that's
you,
going to matter. Okay.
right,
But we're talking just here's how much I'm borrowing for the loan to own, to get this house, to own, to live in this house. And then the value of the home is what the appraisers do, right? They're going to determine the value of the home based on subject properties that are nearby and how much they
right.
sold for, and also
Mhm.
similar structures. There's a lot that goes into that.
Yes,
A lot that goes in,
appraisals.
and definitely not our wheelhouse.
Right,
But got to somewhat be familiar with how that works. And so they're going to determine ultimately the value, and then we're comparing that the loan, how much you owe on the loan, to the value of the home, and the difference of those two numbers, because they're going to be different numbers. If they're not
right.
different numbers, that's a problem. So they have to be
Mhm.
different numbers. When you subtract that, the difference, that's the equity. In other words, the value that you have already paid off in the home, the equity in the home. That's what that's called.
Amount loan divided
Mhm.
by the appraisal, then you multiply by 100, and you get a percentage. So
That's right.
let's say you get a percentage of 80%. The 20% is how much equity you have in the home, basically.
That's right.
And then
When we
the
subtract them,
80% is what you owe.
that's correct. And that's how the lenders are looking at the risk.
Right.
Because if you got an 80% on your loan, they will look at that more favorably than if you
Yes.
have anything above that, like 95
Yes.
or 90 or
Yes.
whatever, right? So
Right.
that will dictate interest rates sometimes. That
Yes.
can also dictate how risky they're going to view that particular borrower.
Right. And
It's
on a
part of it.
conventional loan, if it's at 80%, that means that you don't have to have mortgage insurance.
Right. Unconventional. Absolutely.
PMI. You
Hmm.
don't have to do the PMI because you have put 20% down. So they feel like you got skin in the game, you put money in there, so you're more favorable versus somebody that put nothing down
Yes.
or
You know,
3.4 down.
since we're early on in our video series here, and I
Yes.
know this isn't the subject that was covered in this, but it's important to know, especially
Yes.
since we're talking about loan to value.
Yes.
With that 80% and not needing mortgage insurance, right? You're thinking, what kind of insurance is that?
Mm,
Oh, isn't that the insurance that covers my house in case, I don't know, a tornado rips through it? No,
right.
no, it's not. Mortgage insurance is for the benefit of the lender that
Yes.
you most likely are going to pay for.
Right.
Sometimes there's other ways that that's paid for, future episode. But basically, the vast majority of the time, the borrower is the one responsible for paying for the mortgage insurance because that mitigates the risk of the lender. If
Right.
you don't have the least amount of risk based on how much of a loan you're going to get, right? So if you get a larger down payment, in other words, then you're going to have more favorable terms because you have mitigated the risk yourself by putting more of your own money into the transaction. That's the way they're going to look at it. But if you can't do that, but you still got to get home, you got a family, right?
Right.
Like they don't want to remove that opportunity from those people who potentially are higher risk. So
Right.
what they do instead is they say, hey, look, if you can't do 20% down, that's okay. We can do, 10% down. But here's the deal.
5%.
You're going to pay for the mortgage insurance for us. So that is, if you foreclose on the home, then we're going to get a payout from that insurance policy that you're paying for so that we can continue to have the funds needed to continue doing what we would establish as the status quo for Fannie Mae or Freddie Mac, right? Or whatever lender you're dealing with or entity, I should say. And
Well
so
said.
that's why that's so important that you know that that's not the property insurance because that's what you need to call that.
Right.
Property insurance versus mortgage insurance.
Right.
The insurance is still in there. That's why it's confusing. And it
Right.
deals with homes. That's why it's also confusing. But property's got you and your needs if something unforeseen happens. Mortgage
Right.
insurance, that's the lender. And in most cases, you will be paying for it. So it's an expense we have to consider. But yeah, that's all I wanted to say about mortgage insurance at this moment. And from
Right.
there, we now have the CLTV, the combined. So it's like, combined what? You know?
Right.
Well, funny you should say that. Now we're looking at all debts for the most part. There are some caveats. We're not going to get into all that fine detail in this episode, but it's your mortgage plus the other debts that you have to pay on a monthly basis.
Mhm.
Then that's divided by the appraised value. Boom, there's your combined loan to value or CLTV, as we like to abbreviate everything in this industry,
Yes.
given the amount of words we use for everything. And so that's what that is. Just to be very clear, obviously look into more details about what debts we include if you're a loan officer and you're trying to figure that out right now. There are some criteria. And then for the HCLTV, I have to put in my head,
Yes.
that's a home equity is considered in the equation. It's determined by dividing the sum of the items listed below by the lesser of the sales price and the appraised value of the property.
Mhm.
And so that list consists of the original loan amount of the first mortgage, the drawn portion of a HELOC. We didn't talk about that, but that's it starts getting into subordinate financing and things like
Yeah.
that later on in the section. An HELOC, by the way, is a home equity line of credit. In case anyone's
Yes.
wondering, what is he talking about? Is that a character from like the He-Man series? What
Right.
is that? What is a HELOC? So yeah, that's what that is. And we have the unpaid principal balance of all closed-end subordinate financing. So closed-end, all that means is it's not revolving or open-ended, right? So it's like a second mortgage, right? A
Right.
true, as they call it, a true second mortgage. Whereas a
Yeah.
HELOC is like a credit card. It's
Right.
open-ended, and as long as you've got it open for X amount of time, that's going to keep on keeping on, and you
Right.
just pay the interest. That's the interesting part. Only pay the interest on HELOCs. But as long as there's a principal, there will always be interest. So that's on you to decide when you're going to pay back the principal. Just have to stop paying the interest. Just a little bit on HELOCs there, since it does bring it up.
Yeah. With the HELOC, it's basically you get your home, then you say, hey, I need to get the roof done. Years down the line, you built equity in the home. You've been there 10, 20 years. So now you have a good amount, maybe 30% equity in the home left. So you're like, hey, I want to do some remodeling. So you go to one of your lenders like us and you request a HELOC. They're basically what a HELOC is it's like a second loan on the home. So you're going to be paying two payments. Like David said, you can say, okay, I want to get approved for 30,000. So you got approved for 30,000. With the HELOC, like David said, it's like a credit card, so you don't have to take out the full 30,000. maybe you just use 10. So you have about maybe 5 to 7 years to do the draw. Basically, a draw is when you take the money out. So you have 30,000. You take out 5,000 here, maybe you pay it back. You take out another 10,000 here, but the full amount is 30,000, and you just have to pay the interest. But after that maybe that 5 to 7 years of the draw of you taking out, after that 7 years, you got to pay it all back, kind of like a balloon. You got to
Yeah.
pay the whole thing back within that time period.
Since we mentioned balloon,
Mm-hmm.
we're not talking about a party. Okay. Well, maybe it's a party. But for the most part, with the balloon, anytime you hear that in the mortgage industry, it's basically like whatever's left due, you're paying it right then.
Yes.
Don't ask me why they called it balloon. I'm guessing it's because over time you're getting ready to pay that thing at the end, and it's pushing the.
Yes. Maybe it's inflating till it.
Kind of. When they talk about like a balloon mortgage, they usually talk about how it's amortized for 30 years, but it's going to cut off in 15, or
Yes.
it's going to cut off in 7. If there's some other, and then you just pay everything at that point. So
Right.
depending on your finances, depending on what you have going on, maybe that's a good idea because maybe the interest rate's lower, right? So why would anybody ever want to do that, right? Well,
Right.
because maybe that, or maybe it's ideal. So that's why it's definitely important to ask these questions. If you're working with a lender, hey, isn't a balloon option for me? A balloon mortgage? Is it a good option? Maybe it is. Maybe it isn't.
You have two payments. You have your primary mortgage, and then your subordinate, which is the HELOC. So you make two payments from maybe two different companies. You have a lot of these loans out on the home,
This is
making
true.
you more riskier.
And that also helps to mitigate risk, right?
Yes.
Because that's the only reason they do all these calculations is, well, how risky is this borrower and their circumstances? Because those
Right.
are ever changing, right? For
Right.
most people, that's how it works. Oh, I thought this was interesting. So it says here, if the borrower discloses or the lender discovers the new or increased subordinate financing after the underwriting decision has been made and up to and concurrent to with closing, man, there's so many like legalese here.
Yes.
The lender must re-underwrite the mortgage loan. So it's
Oh,
like,
wow.
that's cool, but you're gonna have to do all that underwriting.
All over again.
Okay. And I think this is a great time to bring up if you're in the market for a house, if you're in contract, right? You've gone through some of those initial steps and you're just waiting for the closing table. Please, I beg you, do not open a new credit card.
Yes.
Do not go and get a loan on a brand new car.
Yes.
Like, don't do anything that involves debt.
Yes.
At least from a credit review standpoint. Like if you're gonna go to your
no
buddy,
financing,
meet
furniture.
for lunch.
Yes.
You were saying, I'm sorry, go ahead.
No financing furniture for the beautiful home.
That's
Wait
right.
till you get the keys.
Yeah, people do that, right? I mean, it makes
Yes,
sense.
they do.
Like, oh, I'm about to move into a house.
Yes.
I'm gonna need to sit and lie down somewhere, right? So I'm gonna eat food somewhere. So of course, like I have nothing but empathy for these folks because that is the next best thing. And you might be waiting a little bit. It just depends, right? Maybe 2 weeks, but you're very excited. You're like, I've got so much energy. Oh my God, this home it's happening. I can't believe it, Like, yes, feel that way.
Yes.
Yes, please. That's what this is all about.
Yes.
But look for the furniture. Don't buy the furniture yet.
Yes.
Like you can still be excited and use that energy to get you through that process because that's honestly that's what helped me get through the process was like I need to put furniture in my home. Holy cow.
Me too.
Like
It helped
I'm not
me too.
excited about that normally.
Yes.
But there was a drive, So
Yes.
ride the wind, do it. Just don't make the purchase unless you're buying cash. Hey, you buying cash? Cash is king, right?
Cash is king.
That's right. If you and you got a place to put it too, because I mean, let's be real here. If you're in the middle of a transition, storage unit, friend's house, I don't know. Careful with that one. But either way, figure out what you want to buy. Just don't make the purchase if you're going to finance. Do that when you close. All these things I mentioned, right? Opening up a credit card, buying a car, the furniture like Bathsheba was talking about, whatever all that stuff is. Wait till after you close. And then you're good. Just a little important part for like newer home buyers and if you're watching, or great tips for fellow loan officers who are most likely watching. So let's see. No other type of recorded instrument documenting or securing the borrower's obligation to pay an amount in connection with funds advanced to the borrower in relation to the first mortgage is permitted. We're going to unpack that in a second. Unless
Yeah.
those funds have been advanced to the borrower by a co-owner of the subject property. So let's see. No other type of recorded instrument documenting or securing a borrower's obligation to pay an amount in connection with the funds. So what that means is you can't say, oh, well, there's this other debt that I'm going to use to pay with this debt that I'm going to use.
Oh,
Can't be doing that. All right. That is
yeah.
not allowed while they're trying to figure out if you're eligible for Fannie Mae. Like, just you can do that later when the cash is in your possession or you got the home
Yes.
equity and then you do a cash out, whatever thing you're going to do later, do it later.
Right.
Don't do it in the process of. There's a lot of scrutiny and a lot of
Yes.
frowned upon things when you're doing financing in the middle of finishing a financing transaction. Like, you're already working on the second transaction, but you yet have not closed on the first one. Yeah, a lot
Right.
of people are gonna have problems with that. Just
Right.
just big no-no. I just avoid it at all costs. If you want to have a smooth, nice experience, for those loan officers that are watching, that's the experience you should shoot for. That's the advice you should give if they're asking for your advice. At the end of the day, it's still their decision. I want everybody to
Right.
know that, right? We can't tell people what to do. We can just
No.
strongly
Guide them.
advise, right? Yeah,
Yes.
guide, nice, gentle, right?
Yes.
And
Gentle.
strongly make a point, right? To say,
Yes.
hey, just I don't. This is how I feel about it. You can feel about it how you want to, but just personally, as a professional, this is how I feel about it. So
Yes.
take that to heart. So from there, after all of that, it then talks about acceptable subordinate financing. So now we're starting to
Yes.
go into subordinate financing. Now everybody's probably wondering, who's not very familiar with this, what on earth is subordinate financing? Like, why has it got to be so fancy? Can't you just
Right.
call it something else? I'm like, I
Right.
wish, I wish. But subordinate financing is basically where you have more than one mortgage on a property, one property, but multiple mortgages, right? In
Right.
whatever form, whether that's HELOC, true second mortgage,
Right.
you name it, right? And what this is talking about is what is Fannie Mae okay with in
Right.
these circumstances, right? Because they're buying these loans. And so they kind of have to know about the risk that that person was involved with, because they may have gotten another mortgage. Because you're wondering, why would I get another mortgage if I'm barely just getting the first mortgage? And it's like, well, remember when we were talking about the loan to value, and we were talking about how if you have 80% on a conventional loan as your overall, or on the loan, you're only doing 80%. You don't have to pay for mortgage insurance. Well, a lot of times subordinate financing is used in order to avoid mortgage insurance,
Right.
because they'll do a primary loan 80%, and then they'll do another loan to cover for whatever they're not including in their down payment. So maybe their
Right.
down payment's only 15%. They're missing that 5% to get 20%, right? Because we need 20% for that first mortgage to make sense, right? So they put down 15%, but then they use the second mortgage as that missing 5%. This comes in handy for people who are in the transition of their lives, right? They're going from one home to another home. But the problem is that they're gonna move into their new home before they sell off the old home. Things are out of
Right.
order, right? But
Right.
they're moving. They gotta go. They got a
Right.
family that needs to be in a home in the new state or wherever else they're gonna be.
Right.
So that's when this subordinate financing comes in handy, because then they could say on that second mortgage, they could say, well, I know that when I sell my house, it's going to be about this much.
Right.
And then we can calculate, all right, then we can make the second mortgage that amount. Then you put your down payment for the missing piece so that we have 20% at least, or
Mhm.
more, whatever, right? At least 80% though. That way you can avoid mortgage insurance. And when you finally sell your house later, you can just pay off the second mortgage and just focus on your primary mortgage. That
Right.
is what it is utilized for the most, right?
Right.
And
If
HELOCs
I
can do the
may.
same. Yes,
Yeah.
absolutely. Go for it.
Right. And great topic. Great topic. That's usually called a silent second.
Yes.
And let's go back to what you said, David, about risk. The
Mhm.
reason why they're worried about that is because the subordinate liens, God forbid you go into foreclosure,
Mm,
the subordinate liens are the last to get paid. First to get paid is the primary mortgage. So they want to make sure that they get paid back if there's
that's right.
for a foreclosure. So that's why you have your first lien, which is your primary mortgage. Then you have your second lien, which could be your HELOC or your HE loan, which is also called a second mortgage. Then you have your third lien, which is maybe you did the roof, you didn't pay the rest of it on time. So there's a certain order on who gets paid. So that's why they want to make sure, Fannie Mae wants to make sure that they get paid first.
ROI, yeah, return on investment. Well, that's great. That's a piggyback, actually, what we were talking about earlier. We're
Yes,
talking about that risk. Remember, primary home, secondary home, investment
right,
property, and like what's riskier? Secondary homes and investment properties are riskier
right,
for lenders because the primary home, people are going to pay their primary home.
right.
That's priority
That's where they
numero
live.
uno, number one,
Right.
right? So
Mm-hmm.
that's the same with lien positions. That's what we call this. When we have multiple
Yes.
loans on one property, these are lien positions.
Yes.
And
Thank you.
well, we're going to move later down the line in Fannie Mae. You're going to find that a lot of the guidelines talk about the importance of Fannie Mae's loan that they're going to buy being in the first or primary loan position. Okay. Because again, it's all goes down to risk. Because in the lien positions, even you can have risk and that's
Yes.
calculated and determined from there, right? So, like you were saying, Bathsheba, when you've got the primary loan, we know that one's going to get tackled first. Anything after that, secondary mortgage, HELOC, et cetera, et cetera,
Yes.
those ones are going to come after the primary. So just like with the occupancy, so is the lien type. They're very similar in how they're determining the risk. Whatever's in front is getting all the attention and it has
Right.
the least amount of risk. And
Right.
that's why Fannie Mae requires, in a lot of cases, that they're not in the second lien position of the
No.
mortgages they're going to buy. That cookie cutter first mortgage position is a part of that shape,
Yes.
right? Shape of that cookie. That's really important to note, and a great kind of tie back to what we were talking about earlier.
Yes.
Now to continue onward here, after we've got subordinate financing, talks about interest rate. If the interest rate for financing provided by the property seller is more than 2% below current standard rates, whatever that might be at that time,
Right.
second mortgages, the subordinate financing must be considered in a sales concession
Mm.
and the subordinate financing amount must be deducted from the sales price. So it will categorize it based on that percentage and based on the moving target that is whatever the standard rates are for second mortgages. It
Oh,
will it'll identify that
yes.
a little
If
bit
I may
different.
also,
Yes.
I'm sure in your state, like in Florida, they have a lot of programs, grant programs for basically second liens. They'll give
Mhm.
you $20,000 down payment assistance. That is, it's a grant, but it's also considered second lien because it has obligations in it. It says that
Yes.
you have to stay in the home for at least 15 to 20 years, and then they will forgive the loan. But if you were to sell the home, and within that time frame, you're going to have to pay it back. So,
Yeah. With grants and with grants, I look at those the same way I looked at when I was going to college and I was trying to
mhm,
apply for scholarships. I don't know if anyone watching this has had a similar experience, but basically there were a lot of conditions that had to be
right.
met in order for me to be able to apply for that scholarship to hopefully finance my school, right?
Mhm.
So that's the same with grants, like to get a
Right.
home, like you were saying, Bathsheba, those conditions. So always be open to look for grants because there's a lot of great things out there, and maybe you have all the conditions that are needed,
Right.
but don't try to get so creative and so topsy turvy with things just to get the grant. Like just look at it as it's a possible bonus, but if it doesn't happen, it doesn't happen. Like I figure that's probably the best way to start looking at grants and programs like that help because then there's some people out there that they just try to get their finances down a certain amount so they can take advantage of welfare programs even though they're just like basically underachieving in order to get the target of well that welfare program and that welfare program and this down
Right.
payment assistance program and I'm like no that's not. I as a professional would never encourage that because those programs are meant for people who really need
Mhm.
at the end of the day. And that's what we're trying to do. We're trying to help people in whatever position they're in, whether that's just advice or actually getting a home.
Right.
That's what loan officers today, that's a bit of, I would hope that everyone takes away from this, at least at the minimum, is like we're trying to help people get into homes regardless of where they're at in their finances, right? So that's extremely important because when we start talking about what it doesn't accept for subordinate financing,
Yes.
there's
What
a
does
lot.
it not accept?
Well, let's see here. Unacceptable subordinate financing terms. First one says mortgages with negative amortization, and you're going to find that a lot.
Mm.
Any any loan that has a negative amortization, Fannie Mae wants no part of it. Okay.
But what is a negative amortization?
That's a great question. So, to really answer this correctly and as easily as I can, we should first define amortization.
Right.
So, amortization is basically where we look at term, how long is it? Okay. And what's the value of that loan? Okay. Like we were talking about earlier, how much is the loan? Divide that into all the months that are involved in those years of that term. And we're going to determine what is the principal that's being paid towards the loan and what is the interest that's being paid every one of those months. Obviously, that will get less over time because the interest is going to be based the outstanding value of the loan. So that's amortization is basically just the ebb and flow, if you will,
Right.
of the mortgage.
So I believe a 30 years is 360 months.
Yes.
The first, I would say the first 3 to 5 years, you're just paying basically interest
Yes.
on the loan because they're wanting getting their money back first.
Mhm.
So if your mortgage is about 1,200 a month, let's say 1,000, make an easy number, 1,000. The first 3 to 5 years, probably you're paying 800 in interest, and only $200 is actually going towards the principal. And when you're paying interest, nothing's going on that principal, so you still owe. But back in those days, people used to defer the interest. When you defer it, doesn't mean that you don't have to pay it back. They just
Right.
put it in the back end.
Kicking it
So
down.
then it starts to add up with the interest plus the principal and the other interest you forgot to pay. And
Yeah.
that's why it becomes negative because you're like you're never really gonna catch up. Like it instead of the monthly payment going down, it's actually going up.
Right.
So instead of
After
it
15 years.
1,000, now it's 1,200,
Right.
1,300. But your income is fixed. So that's where it becomes a negative, and that's where that's a no-no because they've seen that it doesn't work.
Right. It has a predatory lending kind of feel to it.
Yes,
And at the end of the day, the CFPB, big guys, the consumer
yes.
guys
The new
that are
sheriff in town.
that's right. That's right. With all the power of Dodd-Frank,
Yes,
the one ring to rule them all, if you will, Dodd-Frank.
yes,
That is why they're trying their best to make the cookies that the cookie cutter things are making, right?
yes.
Where negative amortization is not a thing, because at the end of the day, that's just suffering.
Right,
That's really what that is. You'll never have enough. And again, like
right,
Bathsheba was saying, your income is fixed, like most people. So
right,
unless variable income, it's going
right.
to be rough. Deferrals.
Deferrals.
Fannie Mae does not like deferred anything,
Right,
especially interest. Oh my God. Most of
right,
what they're going to say in there is like, oh, no, we don't accept that.
right.
Unless it's the employer that's saying these things. Then if it's the employer saying it, well, that's between you and the employer. We don't have to worry about that. And we're okay with that. Otherwise, we don't want it. We don't want any deferred
Mhm,
interest, anything, because again, that likely will lead to negative amortization, which they don't want either. So
mhm.
just when you think negative amortization, just think interest that never will be paid. That's probably the easiest way
And
to
yeah,
determine.
and the loan amount monthly going up because
Oh
it's
yeah,
gonna go
yeah.
up.
When it shouldn't,
Yeah, when
right?
it
When
should it
it
should be
shouldn't.
going down to zero because the total 360 should go to zero.
What they're looking for is stability.
Yes.
In this risky world of lending, they're just trying to get rid of as many unstable things as possible. And in actuality, it's interesting that it always seems to line up with things that are less predatory.
Right.
That's what's really interesting about it. So, to the point of negative amortization, hopefully that covered it for you.
Yes. Hopefully you understand so much.
Yes, that's right. Well, I'm
I
definitely
do.
emphasizing a lot of things in my mind, so I'm getting a lot
Yes.
out of this. Holy cow!
Yes.
Let's see. We got eligible variable payment terms and subordinate financing. So we're getting an extra layer of confusing here, but basically they're just talking about like if you have an arm, and then if you also have a subordinate financing with that arm, and how do they treat that? They start talking about that, and again, they don't want negative amortization, so that's off the table. So if you've got that scenario, they won't take it. That's going to be probably a non-QM if you
Right.
got something like that. And be very careful. Like for loan officers, be very careful because they're going to turn back to you as their advisor if you put them in a negative amortization situation, make sure they fully understand that. If that's the thing that you're going to allow them, like if that's what they want to do, great. But just really make sure they understand that, because man, it's bad, and they won't
Yes.
know for a long time.
Right.
So, but your NMLS ID is tied to that loan if they don't
Yes.
refinance. So
Right.
that's who they'll be looking for. So just be very precautious about it. The next one has the terms for employment subordination. So again, they were only okay with those special terms of deferral and so forth if the employer was taking care of it. So they lift the risk off in that case, and then they'll buy the loan. Fannie Mae will buy that in the secondary market if that's the case. So it kind of
Mhm.
goes into more detail. These are super rare. I don't think we see these too often.
Right.
Um, but for those who have an employer that's paying for them to live in certain places, that's probably when these things come into play. So
Right.
heads up on that. And then we are at the final piece here, which is the resubordination requirements for refinance transaction. And I'll just read the part I highlighted, which is if subordinate financing is left in place in connection with a first mortgage refinance transaction, Fannie Mae requires execution and recordation, funny word of the day there, of a resubordination agreement. So in other words, Fannie Mae needs to be primary, number one lien position.
Yes.
They will not accept secondary position if they're going to
Oh,
buy that loan. Okay. So as far as the lenders go, they're always going to try and appease Fannie Mae because that's how they're going to get their money back, right? If they're going conventional. So it's like, I got to make sure this is in line with Fannie Mae. And so that's why this matters, even though that's secondary market, like we were saying earlier.
sometimes the HELOC loans will pay off the first mortgage, making it the primary, making it the first lien. Because
That's
they
when,
want to stay first position.
I see. Okay.
Yes.
So yeah, position matters. It's gonna,
Right.
and a lot of times you'll see subordinate agreement, or
Yes.
it's where they're gonna change positions. So like
Yes.
anytime one loan is paid on a property, whatever loan is below it, if there are multiple loans, is gonna take the first position automatically.
Yes. Right.
That's the way it works.
Right.
But if we're doing something fancy with financing, then and we're going Fannie Mae, because that's what we're talking about here, they're going to want to be in that first position regardless of that second loan that should be taking the primary position.
Exactly.
So they're going to make them sign this agreement that says you're okay with that if we're going to buy
Right.
this loan. Okay.
Although
Otherwise,
you're
we're not
supposed to
doing it.
be first position,
Yep.
you're not. And I need you to be okay with that.
Yep. And so
Yep.
that's what the subordinate agreement, if you ever see
Yes.
that, you ever see that documentation, that's what that's about. Subordinate financing is really good to give us an edge in the market against the retail lender. We can get really creative with financing. We just have to make sure it's going to benefit the customer. At the end of the
Yes.
day, that's the thing. And make sure they understand why it benefits.
Yes.
Like even if it's just general knowledge, just make sure they know. Like it's like, oh, I get it, and make sure they get it because they'll
Yes.
say that all the time because they don't want to look stupid or whatever.
Right.
It's really important for us to make sure that we're getting people homes, but also that we're not putting them in the hole financially, because
Yes.
that's the big risk with these very expensive things. It's the biggest transaction in most people's lives. If clients are watching, something to look for in a loan officer, um, really put them on the coals. You know what I mean? Like
Yes.
question everything.
Questions are important. Clients and lenders, it's important. And this was great.
Yeah, no, I enjoy these
Awesome.
sessions. It gives us a chance to share our knowledge with the world ultimately, and
Yes.
what we think we know also between each
Mm-hmm.
other. And
Yes.
also the comments is a great place for the discussion to continue.
Yes.
Call us out if you think something's off, of course, we'll get to
Yes.
that. So whatever social media you are watching this on at that moment, also make sure to like and subscribe and heart and join and follow and all that good stuff, et cetera, et cetera. But yeah, love and peace. My name is
Yes.
David Dowd from David James Investments.
And I'm Bathsheba Payoute with Growth Capital at PayouteLending.com.
We hope everyone has a blessed day and take care until next time, guys.